In the third video, devoted to the topic of consolidation workings, we turn our attention to the computation of the consideration paid for the equity investment in the subsidiary, exploring scenarios where the form of the consideration differs from the obvious lump sum paid upon acquisition. We will in turn discuss situations where the payment is deferred in time, contingent upon the occurrence of some future event, or when it is effected by means of a share exchange. Let us again assume that P made an investment in S, acquiring 100% of S's share capital for €8,000. This time, however, we will assume that the €8,000 consideration is split into two parts, €4,000 payable immediately and a further €4,000 which will be payable in 3 years' time. IFRS 3 Business Combinations requires that the amount of the consideration transferred be measured at fair value as at the date of acquisition, and should therefore be composed of the amount payable immediately and the present value of any deferred component, computed so as to take account of the time value of money. Let us assume that the relevant discount rate equals 10%. In that case, the present value of the deferred consideration equals €4,000 divided by 1 plus 10%, or 1.1 raised to the power of 3, producing a result of €3,005. The fair value of the consideration transferred would therefore be made up of two components, €4,000 and €3,005, totaling €7,005. Accordingly, this is the purchase price total which would be taken into account in the computation of any goodwill generated upon the acquisition. Because the present value of the deferred component represents an obligation to make a future payment, it will be recorded within the liabilities section of the consolidated statement of financial position. Over the course of time, as the payment date draws nearer, the present value of the obligation will grow due to the unwinding of the discount applied in the computation of its initial carrying amount. This growth is recorded by posting a credit entry to the deferred payment liability and a corresponding debit to finance costs within the consolidated profit and loss account. It must be stressed that the increase in the carrying amount of the liability from the initial present value of €3,005 to the ultimate €4,000 does not affect the carrying amount of goodwill recognized upon acquisition, which is effectively frozen at an amount computed using the initially calculated consideration fair value of €7,005. Similar logic applies when some of the consideration that is payable for the investment in the subsidiary is actually contingent upon the occurrence of a future event. A contingent consideration will once again be measured at its fair value and included in the computation of the overall price paid for the purposes of calculating the goodwill generated upon acquisition. Computing the fair value of a cash outflow, which is contingent upon the occurrence of an uncertain future event, naturally necessitates the application of a probability weighing to reflect the effect of uncertainty. Such estimates will typically change over time as assessments of probability evolve. These will obviously impact the fair value of the booked liability and will typically be recorded in consolidated profit or loss, as would be the case with any change in accounting estimate under the approach prescribed by IAS 8. Finally, if the consideration transferred takes the form of shares of the acquiring company, the fair value of the shares being issued will provide evidence of the fair value of the purchase price for the purposes of computing goodwill.